For decades, inequality was treated like background noise. Unpleasant, political, emotional, but temporary. The assumption was simple. As long as the economy grows, everyone eventually benefits. The pie gets bigger, slices expand, markets smooth things out. God. Then one economist did something that made a lot of powerful people uncomfortable. He zoomed out, not 10 years, not 30 years, centuries. And when he did, the story changed completely. This is the story of Thomas Piketty, and how his research quietly challenged one of the most comfortable beliefs in modern economics. That capitalism naturally distributes wealth over time. This isn't about left versus right. It's about arithmetic. After World War II, something unusual happened in the West. Inequality fell. Wages grew rapidly. Home ownership expanded. The middle class exploded. From the late 1940s through the 1970s, prosperity looked broadly shared. Economists saw this and assumed it was the natural state of advanced capitalism. Growth rises gives inequality, falls gives markets self-correct. But here's the problem. That conclusion was drawn from a very short window of history. Roughly 30 years. In economic terms, that's a snapshot, not a pattern. When Thomas Piketty began his research, he didn't start with ideology. He started with tax records, estate archives, income reports, national accounts. He compiled data across multiple countries going back to the 18th and 19th centuries. And when he stitched it together, something uncomfortable emerged. The post-war equality era wasn't normal, it was the exception. For most of modern history, wealth has been highly concentrated, especially in the 19th century. The world of industrial expansion was indeed dominated by rising wages. It was dominated by inherited capital. Ownership mattered more than effort. So why did inequality fall after 1914? Not because markets suddenly became fair, because capital was destroyed. 2 world wars wiped out fortunes. Inflation erased savings. Governments imposed aggressive taxation. Assets were physically and financially obliterated. Equality didn't emerge from market maturity. It emerged from shock. Once those shocks faded, once growth slowed and assets recovered, inequality began rising again. That's not ideology. That's what the long-term data showed. Here's where the framework becomes powerful. Piketty separated income into 2 categories. Labor, money you earn by working. Capital, money generated by assets you own. Labor has limits. You have finite hours. Your salary grows slowly. Your productivity improves incrementally. Capital doesn't have those constraints, it compounds. A stock portfolio doesn't need sleep. Real estate doesn't negotiate for raises. Its ownership scales without physical effort. Now here's the key relationship that made headlines when his book, Capital in the 21st Century, was released. When the return on capital exceeds the growth rate of the economy. Wealth accumulated in the past grows faster than income earned in the present. Simplified. If assets grow at 5 to 7% and the economy grows at 1 to 2%, owners pull away from workers. It's not because of conspiracy, because of math. Over long enough timelines, compounding dominates wages. In high-growth environments, rising productivity can lift wages alongside capital. But in mature economies, where growth slows, capital doesn't slow proportionally. Returns persist, growth decelerates, and the gap widens. This explains several modern phenomena. Housing prices rising faster than incomes, stock markets booming while wages stagnate, inheritance becoming more decisive than salary, asset ownership defining opportunity more than career advancement. The system isn't malfunctioning in these moments. It's functioning exactly as designed. Returns flow to ownership. Critics argue that innovation disrupts wealth concentration, new technologies create new billionaires, old industries collapse. Mobility exists, and that's true at the individual level. But Piketty's work wasn't about exceptional stories. It was about averages. For every tech founder who leapfrogs into wealth, thousands remain in wage-based structures. Mobility doesn't negate structural concentration. It coexists with it. Over centuries, the data suggested that the underlying accumulation pattern persists. Here's where it gets more subtle. Inflation erodes wages and cash faster than it erodes assets. When central banks inject liquidity, asset prices often rise. Equity markets expand. Real estate appreciates. Meanwhile, wages adjust slowly. so inequality can widen even in periods of economic recovery. The system looks stable on paper, but purchasing power shifts upward toward asset holders. Again, not moral judgment, mechanical reality. When Capital in the 21st Century was published in 2013, it landed at a sensitive moment post-2008 recovery. Central banks expanding balance sheets. Asset prices rebounding sharply. The dominant narrative was, the system works, just be patient. Piketty didn't attack that narrative emotionally. He extended the timeline. Once you zoom out far enough, comforting stories start collapsing. Long periods of equality appear rare. Wealth concentration appears recurrent. Major reductions in inequality correlate with disruption, not smooth market adjustment. That perspective unsettled both critics and supporters because it reframed the conversation. Not is inequality unfair? But what does capital naturally do over time? This isn't just academic. Once you understand the mechanism, your financial decisions change. Instead of asking, how hard should I work? You ask, what do I own? Instead of asking, is the economy growing? You ask, who captures that growth? In a low-growth environment, asset exposure matters more than career acceleration. Compounding doesn't reward effort, it rewards ownership. That doesn't mean effort is useless. It means effort without asset acquisition has structural limits. Piketty didn't claim inequality is morally inevitable. He showed it as mechanically likely unless interrupted. Markets distribute returns to ownership. If nothing counteracts that dynamic, accumulation intensifies. It's interruptions, wars, taxation shifts, policy changes, financial shocks can reset the system. But resets aren't automatic. They aren't polite. They don't occur because markets feel fair. The dangerous mistake isn't political disagreement. It's misunderstanding structural risk. If you assume rising inequality is temporary noise, you misread long-term incentives. If you assume markets naturally equalize outcomes, you misjudge exposure. History doesn't repeat exactly, but capital has habits, and its strongest habit is accumulation. The question isn't whether that's good or bad. The real question is, are you positioned as labor or as capital? Because over centuries, one side compounds, the other competes. And arithmetic eventually wins.